Ashwini Agarwal is joining us, founder of Demeter Advisors. Ashwini, thanks so much for taking the time and pleasure speaking with you as always. What do you, so would you agree that that a lot has happened over the course of the last week or so, and not least of it is the trade deal? There's the entire budget and how that panned out, the expectations that were building in there. There's STT, there's a few other things. There's a lot of announcements on the global stage as well. How are you making sense of all of that?
Good morning. Thanks for having me on the show. I mean, you're right. Last week has been very momentous in terms of news flow. The budget overall, steady as she goes, kind of a budget. And given that large fiscal measures had already been taken ahead of the budget in terms of GST rate rationalization, one didn't expect a lot from the budget. And to that extent, the budget, I don't think, disappointed me so much. I think the medium-term fiscal path of consolidation remains on track. I might have wished to see a little bit more force on capex, but that's okay. That's debatable. I think the STT increase obviously hurt sentiment, but I think the medium-term steady as she goes is actually quite positive and was, not appreciated by the market on the day of the budget. But I think subsequently the US deal has helped, bolster sentiment. The US deal is obviously very, very positive because, we have large labor-intensive exports to the US in textiles, in gems and jewelry, in engineering exports, and chemicals. Chemicals not so employment intensive, but it's a large addressable space. So to that extent, this deal, if it indeed comes without any addendums, is quite welcome. And I think it's very positive for the economy as a whole. It's very positive for India. It's very positive for the markets and the sectors and stocks that benefit from it. So I think, yes, things are looking up finally after almost 6 quarters of pain.
Yeah, I was thinking about how appropriate the Beatles song "Here Comes the Sun" is, right? It's been a long, cold, lonely winter, especially in the context of those global markets heading higher. But Ashwini, I wonder what you think about the latest development, the Anthropic update, and it sent a little bit of a worrying signal across all of these IT companies. We're seeing IT as a pack down over 5% right now as we speak to you. Is this overdone, or is it appropriate to be this worried?
Honestly, I don't know because the industry, some parts of the industry are being disrupted. So if you look at the headcount growth last year for IT services companies, it's negligible. So the IT services companies themselves are deploying a lot of AI tools. And that's visible in the fact that their revenue is growing, but their employee headcount is not. Now, if this trend gets a lot sharper because you have tools that are available and much more productive kind of programming available, which is automated, then what happens to IT services companies? So, it's a little bit like the industry is going through some disruption. There are elements of that disruption which benefit the IT industry, but there are elements of that disruption which hurt the IT industry. So on balance, where it will sit, I'm not able to say. The valuations are not terribly expensive. These are well-governed companies with very solid cash flows. So, one could make an argument that this is a buy, and I've been wondering about that for quite a while. But in the middle of a disruption, I'm not sure where this camel is going to sit. So I'd prefer to sit out and wait. Valuations are not so, so salivating that one can take the risk and go in. I mean, that would happen if the dividend yields were like 6-7% or something like that, which they are not. So I'm going to stay out for the moment.
Okay, you're going to stay out of at the moment, Ashwini, when it comes to IT. My question coming to you is, so Hiral on this side, you have FIs which have just started to flock back to the Indian markets. A little over 5,000 odd crores is what we've seen. I know it'll be very early to call out what they will do going ahead. But the usual trend is Indian IT, Indian banks, is where the momentum picks up the moment FIs start coming back. And that's absolutely evident with what's happening on Bank Nifty as well. Anything that you like in terms of Bank Nifty? I mean, would you prefer Bank Nifty? And if so, PSUs or private?
Great question, Neil. Thanks for having me on the show. I think banks will continue to do well. I think in PSU banks, you have the narrative that the credit costs are very low. They have the deposit franchise, and in a liquidity challenge environment, having access to a good deposit franchise always helps. Valuations are reasonable too. But at the same time, even in the private sector, if you see, valuations are quite reasonable. Growth outlook is improving. Spreads are obviously challenged right now because of the interest rate cuts, but I think we are pretty much at the end of the interest rate cut cycle. So to that extent, steady spreads with reasonable credit costs and growth improving is a very solid narrative, both for private sector as well as for the PSU bank. So yeah, the bank nifty looks really good. Um, I hope what you're saying is right, that the FI momentum will continue. They've been negative flows for the last 2 years almost, and relative valuations of India versus other EM have now contracted to a normal premium as opposed to a very excessive premium that was prevalent towards the end of 24. So to that extent, if the money flow comes in, yes, some of it might go to IT services companies because they've usually been favored by foreign investors. But I would think that dig deeper down. I mean, I would say pharmaceuticals, chemicals, a lot of domestic demand plays, even among the large caps, and a lot of new listings in the platform space, etc., might be equally exciting. So for me, yes, banking is a core area, but I'm also looking at domestic manufacturing, exports. I'm looking at chemicals. I'm looking at a whole host of industries where stock prices have either gone nowhere in the last 2 or 3 years or have corrected sharply in the mid-cap, small-cap space where one is seeing opportunities.
So, Ashwini, that's an interesting point that you make, because we were just comparing the PAT growth by market cap for Q3 FY26, which tells you an interesting story where profits of large cap companies have seen a growth of around 8 to 9%. Mid cap companies is around 18%, and small cap companies is around 40%. That's the kind of growth that you're talking about in the third quarter in terms of profitability. And this is just 50% of your 500 companies that have reported numbers so far. And in that kind of a scenario, would your bets be then with the broader market, specifically the small caps and the mid caps? And to target that, anything that you like from chemicals, textiles, or industries where which were impacted by tariffs as well?
I do like small caps quite a lot at this point. I think a lot of the earnings trajectory will start improving over the next 1 to 1.5 years as domestic demand stabilizes, export demand picks up, and general business conditions seem reasonably benign. So my sense is that small caps where stocks have fallen 30, 40, 50%, one should definitely take a look at. On the export side, whether it's chemicals or whether it's textiles or whether it's small engineering product companies that are led by exports, all of these look very good to me. I think the full impact of the trade deals with EU and the US will play out over a period of time. It's not going to happen immediately, especially the EU one. But the US tariffs will hopefully kick in starting first quarter of the next financial year. The impact of that will start to be visible. So if earnings growth is very solid and valuations are more reasonable after the price correction, I would be very inclined to go there. And I do find a lot of interesting opportunities in the sectors we just spoke about on a bottom-up basis. What is also true is that the aggregate valuations of small caps still don't look attractive, but I think, it's a barbell situation where some stocks are actually quite attractively priced, while others are very, very expensive. So I think, one has to be very selective and make sure that valuations and cash flows and balance sheets of the company are in order before you buy. And if you take a 1 year view, which is not really a very long view to take, 1 to 1.5 year view, I think there's a lot of money to be made.
Very interesting. Ashwini, heading into yesterday or day before yesterday when the trade deal was announced, a lot of portfolio managers that we were speaking to were focused inward, and they were focused on India and saying that your domestic-facing companies, industries, possibly in the consumption space, one would assume that they were anticipating that with a lag effect, this consumption would pick up in FY27. Does that thesis change in your opinion? First of all, did you buy into that thesis? Did you also see consumption picking up with a lag? Because we did see that income tax cut, but we're still waiting, I think, to a certain extent for that big consumption boom to take place. And the GST push has added some benefit, but we're not necessarily seeing those huge improvements in consumption. What do you think?
So I think, it's a situation where you have to separate the real and the nominal growth. The challenge that the market is facing and consumer companies are facing is that there is no pricing power. So you're seeing consumers return, but the pricing power has been taken away for a variety of reasons. And that is resulting in fairly tepid nominal growth, both on the top line and on the earnings. And markets, we are spoiled to see a revenue growth of 13, 14%, 15%, earnings growth of 20%, and those numbers are not visible. So that's one challenge. On the other hand, the demand, I think, has been reasonably okay. So if you just, look over the last 5 years, you had a big lull, in COVID. Then you had a resurgence after that, and then you had a shift away from consumption into capital assets, including autos and real estate. And now I think, that entire post-COVID boom bust across industries, that has kind of stabilized, and now you are in a normal key. The spoiler over the last 1 year was the higher tariffs being imposed on Indian exporters, especially for the US, which is a large destination for Indian exports. And that too has now been resolved. So my sense is that consumer demand will pick up. Will pick up gradually. I think if you're okay with the kind of earnings growth numbers I'm talking about, which are in double digits barely, they're fine. I don't think I would expect more than that, but that will give you a debt plus kind of return. I don't think you're going to make gangbuster returns, but the places where you will make a reasonable return of 20% or more would be the beaten down stocks where business is normalized, but valuations are still attractive and the prices don't recognize the fact that business has normalized or should normalize in the near future. I mean, I think that's where the opportunity is.
Many such opportunities, in your opinion, and I know that you've already spoken broadly about a few sectors that you like, but are there many such opportunities in your opinion?
Yes, there are many such opportunities. I mean, it's a vast space. I mean, even if you take a cutoff, of $100 million as market cap, which I know is very small for a lot of investors on the institutional side, or even I dare say on the AIF side. But it's not a small market cap for individual investors. I mean, there's a huge plethora of companies you can pick and choose from. Several of them are very good, well managed, solid balance sheets. Their valuations are very attractive, and stock prices have fallen. I mean, I don't see why one shouldn't be buying them.
Lots of opportunities, Ashwini, there, and I think the confusion right now for retail investors is where to put their money in, and that's where the clarity is needed over the next couple of sessions as well. Probably that's what the street should be watching out for, with the multiple events from geopolitical issues to tariff concerns to budget announcements. Everything has come together, and now you have the RBI monetary policy as well that will be slated tomorrow. But thank you so much for joining in. It's always a pleasure to have you on NDTV Profit. So that's Ashwini talking to us.